Okay, so picture this. You're walking down the aisle at Dollar Tree, maybe grabbing balloons for a party, stocking up on snacks.
Or just that, thrill of the hunt feeling, finding something unexpected.
Exactly. That hunt for value. And today, we're pulling back the curtain on what makes it all tick, the recent financial results for Dollar Tree Inc. We're doing a deep dive into their first quarter of fiscal 2025. That ended back on May 3rd.
hmm We've gone through their earnings report, the supplemental data, the earnings call transcript, the whole lot.
Right.
And our goal isn't just to read off numbers, it's to really unpack what these results mean for the company.
Yeah, what's the story behind the numbers? How did they actually do? What about these big strategic moves like selling Family Dollar, the multi-price thing? What's the
And
impact?
what are they signaling for the rest of the year?
Yeah.
Basically giving you the key takeaways without you having to wade through all the documents.
Consider us your guides through the financial maze.
Exactly.
Okay, let's dive in. Headline performance from Q1. What are the big numbers we should know?
Well, first off, net sales were strong. Overall net sales jumped 11.3% compared to last year. Came in at $4.6 billion for the quarter.
Wow, over 11%. That's pretty substantial growth.
What about just the Dollar Tree stores themselves, the main brand? How did same-store sales look?
Also very healthy. The Dollar Tree segment specifically saw same-store sales or comps grow by 5.4%.
5.4%,
Yeah.
okay. Now, is that mostly because people are buying pricier things with the multi-price rollout, or are more people actually coming in?
That's the interesting part. It was really balanced. Customer traffic was up 2.5%,
Okay.
and the average amount people spent per trip, the ticket size, that was up 2.8%. So both sides contributed almost equally.
Ah, so more feet through the door and slightly bigger baskets. That's a solid combination for driving sales, isn't it?
Definitely.
And how did that flow down to the bottom line, earnings per share?
So diluted EPS from continuing operations, that's the core business without Family Dollar stuff, was $1.47.
They also give an adjusted number, which pulls out some one-off things like insurance gain and costs from their strategic review. That adjusted EPS was $1.26.
And how did that stack up against what they expected?
Importantly, both of those figures actually beat the company's own outlook for the quarter.
Beating expectations is always good news. So the headline numbers for the Dollar Tree brand look pretty positive. What's driving this? Who's shopping there? And why are they responding?
Well, the CEO, Mike Creedon, he pointed to progress on their strategic priorities, said customers are reacting positively to the changes they're making.
And is it just their usual customers shopping more, or is the customer base itself changing?
That's a really key takeaway here. They're attracting a really diverse mix of customers. Dollar Tree actually accelerated its market share gains in Q1,
Okay.
both in dollar terms and in unit terms, like the actual number of items sold compared to the market. And get this, their unit share gains doubled versus the previous quarter.
Doubled unit share gains. Wow. So it's not just higher prices trickling through. They're actually selling like a bigger slice of the pie in terms of volume.
Exactly right. That points to a real underlying demand. And the growth is coming from, well, immediate consumption stuff, candy, snacks, drinks. Makes sense, right? Quick trips.
Sure.
But also, interestingly, their discretionary item sales saw the highest growth since late 2022. So people are buying non-essentials too.
And are they bringing in new shoppers?
Yeah, they added 2.6 million new customers in Q1 alone.
2.6 million.
And their existing customers, they're coming back more often. The group visiting 3 or more times a month, that increased by 9%.
Millions of new customers and more frequent visits from regulars.
Yeah.
Yeah, you can see how that drives traffic. What about this talk about higher income shoppers? Is that really happening?
It is. They specifically called it out as a, quote, meaningful growth driver. Saw a significant bump in traffic from households earning over $100,000 a year.
Huh. So it's not just folks needing to stretch a dollar, though obviously that's still crucial. It's also people with more spending power seeing the appeal. Why do you think that is?
It seems to be that core formula: value, convenience, and discovery. The low prices and small packs are vital, sure, but the expanded assortment from the multi-price strategy adds another layer. It appeals across the board.
Which brings us neatly to that multi-price strategy, the 3.0 format. Q1 was kind of its one-year anniversary, wasn't it?
It was, yeah. And they're still pushing ahead with the rollout. Converted about 500 more stores to 3.0 in Q1.
Okay.
That gets them to roughly 3,500 total 3.0 stores now. about 3,000 conversions and 500 new builds. They reckon about half the chain will be 3.0 by year end.
And do these 3.0 stores actually perform better? Is there proof?
Oh yeah, the data is pretty clear according to the sources. They consistently outperform the older 1.0 and 2.0 stores. They see about 150 basis point comp lift.
Right, 1.5% higher same-store sales growth compared to the non-3.0 stores.
Exactly. And about 120 basis point lift in ticket size, so 1.2% more spent per trip. And even a small 20 basis point lift in traffic, so slightly more visits too.
So it really is driving both traffic and spending in those stores. It's not just about charging more.
Precisely. It gives them agility, lets them bring in different items at various price points above $1.25, keeps things interesting. And interestingly, they said they're applying learnings from 3.0, like better seasonal stuff, back into the older stores, and that's helping lift performance everywhere.
Makes sense. Okay, but managing more items, different prices, that sounds more complex. How did that impact their margins and expenses in Q1?
Well, gross profit was up nicely, 11.7% to $1.6 billion. And the gross margin rate profit as a percentage of sales actually expanded a bit, up 20 basis points to 35.6%.
Margin expansion, always a good sign. What helped that?
Mostly lower freight costs, which have been coming down industry-wide. Also better mark on the initial markup and lower occupancy costs as a percentage of sales, simply because sales were higher. That's sales leverage.
Okay, but what were the drags on margin?
Higher distribution costs, more shrink, which is, theft and loss, and higher markdown costs. Those partly offset the good news.
Got it. Now, what about operating expenses? SG&A, selling, general, and administrative.
Right, SG&A. That increased by 100 basis points as a percentage of revenue, came in at 27.3%.
So those costs grew faster than sales did, percentage-wise. That puts pressure on profits, right? What drove that increase?
The main things were higher depreciation, basically the cost of their investments in stores, like those 3.0 conversions. Also higher store payroll from wage increases, more general liability claims, and higher utility costs. They did get some benefit from lower stock compensation and needing less temporary labor now that the big wave of 3.0 conversions is past the initial surge, plus some sales leverage. But yeah, the cost increases won out in Q1.
So you see the cost of upgrades and labor biting there. Net, factoring in the gross margin gain and the SG&A increase, what happened to the overall operating margin?
It contracted a bit. Operating margin was down 90 basis points to 8.3%. The adjusted figure was down 80 basis points to 8.4%. So higher costs offset the gross margin improvement in Q1.
Okay, let's pivot to financial health, balance sheet stuff. How much cash do they have?
They finished Q1 with $1 billion in cash and equivalents. Pretty solid.
And I heard they did something with their debt recently.
Yeah, just after the quarter ended, May 15th. They paid off $1 billion in senior notes that were coming due, used cash on hand, and some short-term borrowing called commercial paper to do it.
Okay, managing their debt maturities. What about returning cash to shareholders? Buybacks?
Oh yeah, very active. They bought back almost 6 million shares for about $437 million just in Q1.
Wow.
And then they bought another nearly 800,000 shares for $67.5 million after the quarter ended. So added up, that's over $500 million in buybacks already this fiscal year.
Over $500 million returned to shareholders since February. That's significant. And how's their cash generation from the actual business?
They generated $130 million in free cash flow from continuing operations in Q1. That's the cash left after paying operating costs and for capital investments.
So they have cash, managing debt, generating cash, buying back stock. What are their priorities for using their capital going forward?
They laid it out pretty clearly. Priority 1,
Yeah.
invest in growing the business. Priority 2, return cash to shareholders, mainly through buybacks. Their spending plan, CapEx, for this full fiscal year is pretty hefty, $1.2 to $1.3 billion.
That much? What's that going towards?
About 400 new Dollar Tree stores, plus a big chunk, $110 million, just to rebuild that distribution center in Oklahoma that got hit by a tornado last year.
Is this level of spending the new normal, though?
Actually, no. They specifically said fiscal 25 is expected to be the peak investment year in their current cycle, which implies spending should ease off in 26 and 27.
Okay, that could free up more cash down the line. Now, the elephant in the room, the Family Dollar sale. What's the latest there?
It's moving along. They're still expecting it to close sometime in the second quarter, so like early summer. And they've got the green light from U.S. antitrust regulators.
And remind us who's buying it.
It's a group led by Brigade Capital Management and Macellum Advisors. They have a firm deal in place.
What kind of money are we talking about from this sale?
The headline purchase price is just over $1 billion, $1,007 million. But that can change a bit with adjustments. They figured the net cash they'll actually pocket is around $800 million. But that's not all. They also expect a pretty significant tax benefit from the losses on the sale. Around $350 million is the estimate there.
Okay, so $800 million cash plus $350 million in tax benefits adds up to over $1.1 billion in total economic impact. And how does this affect how we should look at their numbers right now, before the deal is done?
Yeah, this is key. Family Dollar's results are now reported separately as discontinued operations. So the main numbers we've been talking about, the sales, the EPS, this is just the ongoing Dollar Tree business, makes it cleaner to analyze.
Gotcha. What about shared services, like a corporate functions that served both chains?
Right. They're setting up what's called the Transition Services Agreement, or TSA. And this is crucial for understanding the next few months. Basically, Dollar Tree Corporate keeps paying the full year's cost for providing these shared services.
Okay.
But they only start getting paid back for those services by the buyer after the deal closes, which won't be until the second half of the year.
Hold on. So they bear the full cost burden for the first half, but the reimbursement income only shows up in the second half.
You got it. That timing mismatch really hits profitability in the short term, especially Q2. They expect to get $85–90 million in reimbursement for the whole year, but it won't really start flowing until Q3 and Q4.
Ouch. That sounds like definite new-term pressure.
Sure.
Okay, speaking of the future, what's the outlook for the rest of fiscal 2025?
For the full year, they kept their sales guidance the same, $18.5 billion to $19.1 billion. That assumes 3% to 5% comp sales growth for Dollar Tree stores.
And earnings, adjusted EPS.
They tweaked the full-year adjusted EPS range slightly upwards to $5.15 to $5.65. Said that mostly reflects the impact of the share buybacks they've already done.
Okay, what about the second quarter specifically? How's that looking?
Sales-wise, they expect Q2 comp growth to be towards the higher end of that 3% to 5% range. So sales momentum looks set to continue.
But you mentioned that TSA timing and other things creating volatility. What does that mean for Q2 profits?
This is where it gets rough. They warned that Q2 adjusted EPS could be significantly lower year over year, potentially down as much as 45% to 50%.
Whoa, down 45–50% year over year in Q2 profit after a Q1 beat. What's causing such a massive temporary drop?
It's that perfect storm of timing issues. First, costs hitting now, especially tariffs. Some higher tariff goods landed in Q2 before they could fully react. Second, the costs of actually implementing their tariff mitigation plans were higher than expected in Q2, about $40 million more. And third, that TSA timing thing we just talked about, costs without the income yet.
Okay, so a triple whammy. Tariffs hit, mitigation costs hit, TSA income hasn't hit yet, all landing in Q2.
Exactly. They believe the benefits of mitigation and the TSA income will really kick in during the second half. That's why they're still confident about hitting the full-year EPS target, despite this Q2 hole.
Makes sense. How are they thinking about tariffs longer term? It's always uncertain, right?
Their forecast assumes today's tariffs stay put. They sounded pretty confident they can handle most, if not all, of the earnings hit using their 5 levers.
Right, those levers are.
Negotiating with suppliers, changing product specs, shifting sourcing away from, say, China, dropping some items altogether, and crucially, using that multi-price flexibility. They put the total potential hit from higher tariffs for the rest of the year at around $200 million pre-mitigation and framed that as manageable. Less than expected wage inflation, they said.
So the plan is, take the hit in Q2, let the mitigation and TSA income catch up in the second half, and land the year on target. How does that translate to the full-year margin and expense forecasts?
Full-year gross margin is expected to improve, up 50 to 75 basis points.
Right.
But the Dollar Tree SG&A rate is expected to increase or deleverage by 110 basis points, reflects those investments. And corporate SG&A costs are forecast up about 20% for the year before you count that TSA income, which again, mostly helps in the back half.
Okay, beyond the big financial picture and the sale, any other interesting operational or strategic bits?
Yeah, a few things. Store growth continues. Opened 148 new Dollar Trees in Q1 and hit their 9,000th store milestone. Big focus on inventory, too. Bringing stuff in early for key seasons. Back to school, Halloween, Christmas, trying to get ahead of potential disruptions and make sure shelves are stocked, and investing in stores to handle that flow.
Smart move in this environment. What about where they get their products? Global sourcing.
Philosophy hasn't changed. Lowest landed cost to deliver value. That means using all those levers, including shifting country of origin where it makes sense, being agile.
And that multi-price strategy, it's not just about products, it's pricing flexibility too, right?
Exactly. Not totally abandoning the $1.25 core, but strategically using higher prices where it fits the product and customer expectation. They even mentioned exploring zone pricing.
Zone pricing, like different prices in different regions.
Sort of, yeah. Maybe subtly tweaking prices or assortments in certain areas based on local demographics or what value means there, while keeping the main stuff consistent. It's an interesting evolution.
Definitely feels like a shift. And are they trying to tell people about all these changes?
Seems like it. They talked about leveraging social media buzz, like those TikTok dinners people make from Dollar Tree stuff, and also looking at more formal advertising to boost awareness of the wider range, especially across different income groups.
So, sounds like despite the near-term pain points, they feel pretty good about the core Dollar Tree model.
Yeah, they expressed confidence, pointed to their agility, their employees, and just how the Dollar Tree value proposition fits the current consumer mood. They feel they can navigate the bumps.
And if people want the really deep dive on the future strategy,
Mark your calendars. They're planning an investor day in New York, October 15th, to lay out the long-term vision and financial plan for just the standalone Dollar Tree business after Family Dollar is gone.
okay, so let's wrap this up. If you had to boil down Dollar Tree's Q1 and their outlook, what's the main takeaway?
I'd say the core Dollar Tree brand is showing real strength. Sales momentum is good, driven by value, but also by smart moves like multi-price. They're pulling in new customers, different kinds of customers, and keeping existing ones coming back.
But there's a but. They're definitely fighting some battles right now.
Absolutely. Absorbing investment costs, dealing with tariff timing, and especially that awkward Q2 period with the Family Dollar TSA costs hitting before the reimbursement. That's going to cause a significant, but they stress temporary dip in Q2 profits.
Right. The confidence comes from believing the fix's mitigation efforts. The Family Dollar sale closing will drive a second-half recovery and let them hit their full-year goals.
Exactly. It really paints a picture of the complexities of running a giant retailer today, doesn't it? Balancing strong customer appeal with these tough operational and global economic headwinds.
Yeah, it shows that even a simple concept like dollar store value requires some pretty sophisticated juggling behind the scenes. So here's something to think about. As Dollar Tree emerges as this focused standalone company, armed with multi-price flexibility and clearly targeting a broader audience, how might that fundamentally reshape its position? How could it change the competitive game in discount retail over the next few years? Something to chew on as they navigate this peak investment phase and look towards that second half rebound.